We want good fundamentals and we want cheap stocks. If we have those two things, we're going to have those moments like you're describing where they're going to go against us. It will inevitably happen. But over time, the market's going to figure it out, and they're going to drive those stocks towards fair value, and we'll make money. It's when you're buying something that's at a premium and it's got a momentum to it. I think there's a lot more risk in those names for us and in our space than there is in buying a value name where you clearly know what the value is in the private market with good fundamentals.
Welcome back to On the Tape. We're going to go off the tape now, and this is a very special guest. We're joined by Jonathan Litt, the founder and CIO of Land and Buildings. Typically, I'm joined by Caitlin Malin, the COO of iConnections, but Caitlin's a busy young lady, so it's just Jonathan and I. Jonathan, it's an absolute pleasure to have you on.
Great. Thanks for having me on today.
So I think we're in the verge of some very interesting times for you, although, as you can say, the last couple of years have probably been fascinating. But before we get into the sort of the granular stuff and what you're seeing, talk about you, talk about your path to where you are, your background, because I think the audience is always fascinated to hear some of the backstories.
I'm the founder and CIO of the firm, goes by the name of Land and Buildings. We're celebrating our 16th anniversary this summer, so we're quite excited about that. We invest in liquid real estate, think REITs, real estate operating companies. And what we found is there's a great arbitrage between owning in the public markets, because we know what's happening in the private markets because it's so big and it's so liquid. And so we try to capitalize on that arbitrage and unlock value occasionally through activism. And it's been a very fruitful area to be operating the past 16 years. My background before that was I was a sell-side analyst, mostly at Citigroup. We were the top-ranked team for most of the 14 years I did that. And I loved it. It was a ton of fun. I met great people. We were clear shareholder advocates. I really wanted to get into investing, which is why I left the sell side. And I love what I'm doing here. And we built a terrific franchise. And I think we're well established as the leading activist within the publicly traded real estate space.
No, I'll say this. I mean, I'm not just blowing smoke, but I think you've become the gold standard in the space. So it's really an honor to have you. As I said, it feels as though we're on the precipice of something. But, you mentioned activist investing and 16 years in, but there's been an evolution to activism without question across a swath of different sectors. Can you speak to that evolution? Because, we used to say at Goldman Sachs, consistency is a moving target, and what worked a week ago is not necessarily going to work today.
That's certainly happened. And also, I think many investors think of the board and the management team as monolithic, and they're super smart. They know what they're doing. You don't question them, and you invest alongside them. And I think one of the things that we found when we started doing activism was there was very much that mentality. Like, what are you doing here? Why are you questioning us? We know what we're doing. And what we found is, we've been involved with over 40 engagements, is usually the boards are complacent. It's not that they aren't doing their job. They've just been in the chair too long. And when you come to them with a sound argument about, hey, why are you trading at a discount? There's some things that you can be doing. They tend to do the right thing. And I think the evolution for me is that the boards and management teams are much more receptive than they were when we started doing this. And we get a lot more settlements. We get a lot of good outcomes. We've had, I think it was 15 of the 40 plus companies have been sold. And we say to them, hey, let's try to fix this. If we can't fix it, let's sell it. In real estate, we have a unique position because there's, lots of buyers, whether it's the public or private market. But I think they've become much more willing to work with us.
Over the last couple of weeks, seemingly every day, but it's not, I know, but I'd say a few times a week, I see these headlines come across. And last week I saw one, and again, this is granular, but it speaks to sort of, I think, what's happening. The owner of San Francisco's largest apartment community has defaulted on $1.8 billion in loans tied to the complex. The 152-acre, 3,200-unit apartment community known as Pac Merced was just appraised at $1.4 billion, plummeting $700 million from 2019 and $400 million less than the total loan balance. I mean, again, anecdotal, but we're seeing this more and more. Then last week, We saw an article in the Wall Street Journal. Real estate meltdown strains even the safest office bonds. Commercial real estate mortgage-backed securities are experiencing increasing defaults, including previously low-risk office bonds. And this is seemingly, again, not every day, but there's been this steady stream of stories that are sort of lining up in your world. So I'm not asking you to speak to the specifics, but speak to, I guess, what we're starting to see over the last couple of months.
I've been in this business for a little over 30 years. And one of the remarkable things that we see is there's a life cycle to each property type. And real estate touches all parts of the economy. When I started, regional malls were the hot thing. And that was before we had the internet and e-commerce. And you know what? Regional malls aren't the thing anymore. And they've gone through this life cycle. Office has gone through a life cycle. People are not in the office the way they were. And that sector's got many more years of pain to come. Unfortunately, apartments by and large in the U.S. are doing very well. Unfortunately, San Francisco is really taking it on the chin in the return, post-pandemic world. Park Merced was a very high-profile, well-located portfolio in San Francisco, but San Francisco has seen huge outmigration, rents under pressure, values under pressure, and I talked about property type geography. This is a property type life cycle. This is a geography life cycle where people are moving away from one market and moving into another market. And so you really need to be on your feet. You can't sit on your laurels and go, oh, I own this building in this spot. It's going to be great forever. That's not the case. And I've learned that lesson over and over again.
There's a criteria that you have for identifying underperforming REITs, which I want to get into without question. But I also want to ask you, I think, and please correct me if I'm wrong, you sort of have to have a view on some other things, some underlying things. And I think my sense is obviously interest rates play a significant role in this, but I would also imagine the unemployment rate and sort of the state of the consumer and those type of sort of at times nebulous indicators have to play a factor. So how closely do you watch that before you put in some of the criteria that you look at that I actually want to talk about as well?
Well, you and I have been in the markets a long time. And unlike the private markets, you wake up in the morning and, somebody shot a missile or you got a bad PPI number or an employment number and, the stocks get whipped around. So you have to be very aware of a lot more than if you're operating in the private markets. But clearly in real estate, you have a spectrum. You have assets which are leased every day. Think of a hotel. And you have assets which are leased every 20 years. Think of a Walgreens or a Walmart net lease asset. You probably don't have to worry too much on the Walgreens and Walmarts of the world type of assets because it's going to take 20 years till you got a problem when that lease comes due. But in the hotel business, you have to worry every day. What's happening with my cost to operate that hotel? Our business traveler is going to show up. Our leisure traveler is going to show up. And so there you have to be very much on top of the economics of the end user. And it moves a lot. I always say, Chris Nassetta, who runs Hilton, who's really fabulous CEO, and he tries to give us guidance every quarter about what's going to happen in the next year. He doesn't really know. Mm-hmm. I mean, he tries his best based upon what he knows. He's going to do better than the rest of us. But, you're looking out 12 months. You don't know what the landscape's going to be. And you got to, make your best guess and then monitor the data as aggressively as you can.
So it's not just you licking your finger and putting it up in the air. I mean, as I said earlier, there's a criteria that you have to try to identify and then take advantage of what you believe are going to be these underperforming REITs. And, some obviously, to your point, not all are created equal. I mean, within that umbrella, there's a litany of different things. So speak to the criteria that, you and your team look at.
Sure. I mean, first, we need fundamentals to be stable or improving. One of the things we found is a cheap stock with bad fundamentals is not a recipe for making money. Mm-hmm. You need a cheap stock. So two things, we need a cheap stock and we need fundamentals that are stable or are inflecting and improving. And if we have those two things in place, then we can start digging in and determining whether this is the name we want to own, if it might be an activist and what the strategy might be. And so as part of that, we're going to talk to as many folks as we can to understand what's happening with the fundamentals in the business. And we're going to talk to as many folks as we can to understand what the valuations of those assets are at the moment that we're looking at it, and once we own it during our ownership period. And it's going to vary by property type. We're working on one today, which is advertising focused in the billboard business. And so we're trying to talk to as many advertisers as we can and agencies to get a sense of what's happening in the advertising business over the next 12 months. So we have to, look at it by property type with as part of our analysis.
It's interesting, and I know you know this, and I'm sure our audience is aware. You can do all the work. I mean, you can be as rigorous, and that's a word we used to use all the time, and I'm sure it's a word you use, as possible. You can you look under every single rock and think you have everything at your disposal, yet the market always does things that you never imagined. And in our world specifically, if you're early, you're wrong, and you know this better than anybody. So how does that factor in? Because sometimes, you think you have everything's right in front of you. You're holding kings and aces, yet the market somehow pulls out whatever royal flush or something. So speak to that, because there's a level of frustration. You think, I can only speak for me on the show every night, but you think you've sort of figured it out, yet, stocks can stay crazy before you can sort of figure the whole thing out. Speak to that.
You're 100% right. When company reports, and really we call the come to Jesus moment when a company reports, because between earnings seasons, people can make up a story. This is why we want to own the stock. This is their thesis. And then they announce results and they're just not what you thought they were going to be, or better or worse, whatever the case may be. So, or again, you come to work and, Monday morning, and we had the Trump assassination attempt on Saturday. I don't think any of us were thinking that when we went to when the market closed on Friday, and how's that going to impact the market? So there's these things that come to play that you have to be positioned for. And the way we position for it is by sticking to our criteria. We want good fundamentals and we want cheap stocks. If we have those two things, we're going to have those moments like you're describing where they're going to go against us. It will inevitably happen. But over time, the market's going to figure it out, and they're going to drive those stocks towards fair value, and we'll make money. It's when you're buying something that's at a premium and it's got a momentum to it. I think there's a lot more risk in those names for us and in our space than there is in buying that value name where you clearly know what the value is in the private market with good fundamentals.
It's great to have a longer conversation with you here, but we're also fortunate enough on Fast Money to have you on from time to time. We've probably had you on a half dozen times over the last couple of years. I think your most recent appearance was on June 24th, and I'm paraphrasing to a point, but I think your commentary, the headline was, the hurricane in your world was about to get into full force. So, you don't throw around, platitudes like that lightly. Speak to that.
So I think that stems from a white paper that we did in May of 2020. I remember in April of 20, we're all working from home and nobody knew what was going on. And I listened to BlackRock and Morgan Stanley's calls. Larry Fink and James Gorman commented about how amazing their businesses are running with 95% of the people working from home. And I remember getting off those calls and sitting with my partners and saying, office is not ever coming back. We've got a serious problem. We need to be short office, even where the stocks had already been hit pretty hard. And we did a lot of work on this. We put a white paper out. And our guess was people would be in the office one less day a week. That would contribute to a vacancy rate approaching 15 or 20%. And that would create lending and refinancing problems and all kinds of other issues. And it's far worse than we expected because people are not in 2 days a week. And the banks have now, it's not even a return to office question. We might get people back in the office. The banks have blacklisted office to get a loan at a reasonable rate for most office, not all office, but most of it is hard. And, they're going to take their pound of flesh, refinancing a loan, all of that. So office is really a challenge, and that's the hurricane. It's not a hurricane in real estate generally. It's a hurricane in the office. It's landed. It's pounding away at the group, and it's going to continue to be a challenge. We don't see that letting up anytime soon.
And I agree with you. So let's play this. And again, I'm not looking to get into individual names, but one would think, and I agree with everything you just said, and I've been on board for a while, but at a certain point, you would think you'd see some pain in terms of banks. Now, maybe not necessarily a JP Morgan or some of these larger banks, which have positioned themselves to effectively be too big to fail. There's an irony there, obviously, but these small and regional banks, one has to think there's under the surface, there's some damage being done. Yet over the last couple of weeks, again, speaking to the stock market and how you can see sort of odd behavior, you've seen a rally in these banks as if there are no problems under the surface and maybe these bad loans do not exist. So, speak to that, because I'm sure you've done some work on some of these banks as well.
Look, I think there's a pretend and extend attitude at the banks with regard to these loans. If the borrower is willing to stay in, the banks are extending the loans. And so we're having this pile of loans that should have been refinanced 3 years ago, 2 years ago, 1 year ago, that are now going to roll in the next 1, 2, 3 years. And at some point, there's going to be, and now look, there's a hope there, right? There's a hope that office values are going to recover, and that's why they're doing it. But I think that's why you haven't seen the write-downs. Where you've seen the write-downs is where the borrower says, I'm out. I never am going to make money on this thing. You take the property back. Now the bank has to write it down, turn around, and sell those assets. And when those transactions are happening, they're happening at huge discounts. Now, I don't want to say every single office building in America is values cut in half, let's say. There are assets which are going to be winners in this. People are still going to the office. Those Class A assets that are highly amenitized in good locations will survive. We don't have a good way to invest in those assets in the public market, because you might have some of those, but then you're going to have assets which are more problematic. So we think offices can continue to be challenged.
One of the things you said that day, there's 2.5 billion square feet of office space that's going to expire by 2030. And maybe a lot of it's been written off, we'll see. But how do you wrap your head around numbers like that? I mean, when those numbers are out there, the market's a discounting mechanism. So one would think it's somewhat priced in. But when you see things like that, I mean, we're talking about some staggering numbers here.
Right. And you think about 2.5 billion square feet expiring, and you think the tenants are going to take, call it 20% less space. They're going to add 500 million square feet to the vacancy. And the vacancy is already north of 20%. So that could push you to 25, 26, 27%. That's a problem. And the banks, and when you have more vacancy, you're not only losing the rent, you're losing the reimbursement by the tenant of your real estate taxes, your insurance, your common area maintenance. So your margins are getting crushed at the same time. So it's just like this slow motion disaster that's unfolding for a lot of the office stock. I'm going to say the blue states are a bit worse off than the red states, because the blue states are losing population. They have more lenient return to office policies than the red. And that's not a political commentary. It's an empirical observation. So, we're going to have challenges. We're going to have empty buildings, like we have empty malls, strewn about the country.
They say football is a national sport, and I understand that. They say baseball is a regional sport, which I totally get. And that's the same thing with sort of municipalities, right? It's obviously very specific to the municipalities. But, again, when you sort of think this through, I mean, when you're listening to what you're talking about and reading some of your work, it stands to reason at a certain point that, some of these municipalities are going to have problems. Do you do work on that front in terms of muni bonds and the ramifications of, again, less people working and then the trickle-down effect that has?
It's a good question. We don't. A lot of people have talked about New York City, and what's it going to do is people leave for their residents, businesses relocate, and what's going to happen to the tax revenues. I live in the state of Connecticut. Same thing happening in the state of Connecticut. And they're going to be challenged. For us, we're looking for things to own. So we're just going to go to, where things are good. Not where on the short side, we'll look at where things are problematic, but we don't look at uni bonds.
Future, there's obviously, you got to look forward. You do all your work, and all the work typically is in rearview mirror, but then you sort of, again, you build your empirical evidence and you try to figure out what's the future going to look like. So what do you think the future of the urban office markets is? Because it's not going away per se. It's obviously changing, like many things do.
Oh, well, look, I think there's going to be, you think about Manhattan, that Park Avenue market near Grand Central is going to be a key market. They're going to have Class A, well amenitized, buildings that are going to be well occupied and well rented, and the rents are going up in other markets in Manhattan. But most of the space in Manhattan is Class B space, Class C space. That's where it's going to be challenged. And that's true in most markets. If you think of West Los Angeles, that's going to be a market where people want to live. They want short commutes. They're going to have offices in that market. We just got to get through this period. But one of the things I want to be clear on is we're talking about office, which has got a lot of challenges. There's a lot of property types which are not near the end of their life cycle, but at the beginning or in the middle, and things are really well positioned. And there's great opportunities. Maybe I'll segue into that.
Well, yeah, speak to the current opportunities. Without question, I mean, that's true historically. There's an old Molly Hatchet song, and I'm not suggesting you're a Southern rock fan, but, one man's pleasure is another man's pain. And that's true in this world as well, right? I mean, something goes down, something's going to rise from the ashes.
So let's think about senior housing. Senior housing today, and then go to the baby boomers. You and I are at the tail end of the boomers, but most of the boomers, they're getting to be 80, and the 80 plus population in the United States is the fastest growing part of our population. They can't age in home, a fair portion of them. They're going to need to be in some type of an institutional setting. That's going to be senior housing, where you get assisted living or memory care, with very rapid population growth in that category. Virtually no new supply given the tight financing market. We're going to see an extended period of outsized rent growth and occupancy improvement. We're still recovering from COVID in terms of occupancy, but we think we're going to see double-digit net operating income growth from the senior housing space over the next several years, and we have seen it the last few years, and that should be a good space to be for some time. We always have to monitor supply in any property type, but that setup is really good. Think about, we can't turn on the TV or pick up a newspaper or go on social media without hearing about AI. AI, all these chips have to go somewhere, and they're going into data centers. And the data center demand is exploding, and it will continue to. It was before AI, and it'll continue to see really strong growth. You got to own data centers. And data centers are really well positioned. That's going to be a secular growth story. Senior housing is going to be a secular growth story. And so those are two areas that we think are going to really enjoy a good run.
Obviously you're in a very specific area without question, but it's like anything else. Curiosity takes over at a certain point, and you look at the broader market. And again, I'm not asking for pontification about where you think things are going, but when you look at the performance of the stock market over the last, 6 months, basically, let's just call it this year. Are you surprised by it? Does it make sense? Like, I'm just curious as your thoughts at a 30,000 foot level.
Yeah, I try to stick to what I'm a professional at, which is real estate. And I know our investments, our long positions, are cheap to private real estate values. We spent a lot of time working on it. We got 2 companies sold this year. Blackstone bought 2 of our companies, Tricon and Air. One's a single family for rent company, one's an apartment company, at substantial premiums. We've got other names which we think, whether it's Blackstone or Starwood or other players, would be interested in buying. We know roughly the valuations that they should trade at. We like to deal more in certainties, because there's so much uncertain when you're investing in the stock market, as opposed to saying, does it really make sense where Microsoft and NVIDIA are trading? They're trading there. They got a lot of momentum. The stories sound good. I wouldn't opine on whether you should own them or not. I can definitely opine that, last week, I thought was a bell ringing event for REITs. They've been in a malaise for a year and a half as we're waiting for the Fed. And I think several events last week made it a bell ringing event. The setup from here is really good.
Well, speak to that, because, I asked that question because, we're all human beings, and sometimes, you're very laser focused on something, but sometimes extraneous events like a broader market can sort of cloud your vision and can sort of take your eye off the ball. That's why I asked that question. But speak to the bell ringing event that you spoke of, just 30 seconds or so ago.
Sure. And you know the expression, it's always darkest before the dawn. And it certainly felt like that. The REITs were, really at the whim of interest rates, not at what's happening with the fundamentals, what's happening with private market valuations. There are really two things that happened. First, Fed Chair Powell was testifying in front of the Senate Banking Committee. And he said, and really the first time I saw this focus out of him was that if we wait too long to cut rates, there's a risk to the job market. And we have a dual mandate, which is inflation and employment, which they've been saying forever. But that said to me, they really want to cut. They want to win on inflation and they win on employment. And if they wait too long, they might be a risk. So to me, that was like the groundwork. And then we had the favorable CPI print right after that. So if we look at this Fed tightening cycle, this is the fourth Fed tightening cycle in my 30 years. It's the first one where the Fed has been clear throughout the cycle that they will cut rates, how much they think they're going to cut rates, and roughly the timeline in the summary of economic projections. Rates around, Fed funds around 5.5. They've been saying they're going to go to 3. Now, it's taking longer to start the cutting process, but that overall projection hasn't changed. If those rates get to 3%, real estate value is going to be much higher than where we're seeing today in the private. And so if we're finally getting to the beginning of the cutting cycle, which I think last week, those two events have highlighted, then I think you're going to see a nice 20-25% upside in the REIT index and in our long positions, hopefully more than that.
Makes sense. So I want you to walk me through something, the audience through something, to the extent that you're interested or can. So back in March, there was a journal article and it spoke to, again, Jonathan Litt. You had a 3% stake in Equity Commonwealth. The symbol there is EQC, and you urged the office owner to liquidate for a myriad of different reasons that you can speak to. But walk us through how that works. I mean, that's obviously the activism portion of what you do, and it's fascinating to me, sort of the steps that need to be taken and how the whole, just walk us through the steps and how you think about those types of things.
Sure. And this is a bit of an odd duck because the company got taken over through another activist's campaign. Sam Zell, who's very well known in real estate, became the chairman and they owned the office. And he said, this is terrible business. We're going to sell the office. They sold the office and they were sitting on $2.25 billion of cash. And they had a few little office buildings left. And they said, we're going to go put this money to work in something opportunistic. And Sam was known as a grave dancer, and people gave him the benefit of the doubt. For 7 years, they were sitting on the cash. They never put it to work. And that was through the 2018 sell-off and rate scare, through the pandemic. There were lots of opportunities. Sadly, Sam passed away last year. So the raison d'etre that he had was gone. They're sitting on the cash. REITs are trading at heavy discounts. And we're like, you haven't found anything in 7 years. Just give us the money back. And we think there's 20+% upside to them because the stock itself is trading at a discount to cash. So just give us the cash back. Our point to the management team and the board is, if all the other REITs are trading at discounts, anything you're going to invest in, it's going to trade at a discount the next day. And there's no particular mastery that you bring to the table. You're going to go buy a portfolio and you're going to learn it and you're going to bring in a management team. So give us the cash back. So that's an unusual one for us. We don't see a lot of downside unless they go into a bad deal, but it's an upside to value of the cash. And that we don't have to debate what that is, right? It's $2.25 billion in cash.
It's fascinating. Again, that's just one aspect of your business, but within the framework of the company, you wear many hats. And it's just always interesting to me because that's obviously, I would imagine, as fun as the business is, like there's a challenge associated with the activism portion of things. Is that accurate?
Well, there's some companies where the CEO rules with an iron fist and they will burn the house down before they will do what shareholders want them to do or what an activist wants them to do. I would say those are few and far between. Most management teams and most boards are rational. They'll listen. They know there's a problem anyway, and now they got to deal with it. And, rarely are we the only voice. We might be the tip of the spear, as others have described us. But once we're there and we're talking about it, these companies hear from their shareholders at the board level and at the management level. These aren't like, hey, you're a bad guy, you got to get out. These are, rational conversations. What are you going to do? This is the situation. Nobody thought it was going to get here. Let's figure out a solution.
It's really fascinating having you on. I mean, we look forward to having you back on CNBC, but how can people find you and the firm if they were sort of looking for more information?
Oh, sure. That's easy. landandbuildings.com is our website, and we have lots of white papers and all of our engagements there. You can follow us on LinkedIn or Twitter under my name, Jonathan Litt. And we try to post fairly regularly as events occur.
I'm fortunate enough to be on that mailing list, and it's something I look forward to because I think, listen, you can glean a lot from the work that you do. I mean, you put, again, to use the word I used earlier, the rigor is there, and then it just sort of requires people to sort of take the time to look at it. So, Jonathan, thank you so much for joining us.
Thanks so much for having me on, guy.